example from our textbook from chapter number 2, problem 2.2, the Dover River Company. As you can see, we're given some basic information about operating profits before taxes, interest, etc. And what we need to do is calculate the earnings per share, the payout ratio, the increase in retained earnings, and the PE ratio based on the share price of $26.40. So we have a basic income statement in this particular case. So we simply take the operating profit, which also is referred to as earnings before interest and taxes, of our $200,000. We subtract interest to give EBT, earnings before taxes, of $190,000. So you simply revenue minus your interest expense. We also have taxes. In this case, it's given to us as a certain amount. We don't even need to calculate it. We're then calculated to determine the earnings after tax of $128,750. We also are going to pay out some dividends to our preferred shareholders of $18,750. And so we have $110,000 available to pay out for common shareholders. You're going to pay the common shareholders the $30,000 that's indicated in the question. And as a result, your $128,750 increase to retained earnings minus the $18,750 that you paid out to the preferred shareholders minus the $30,000 that you paid out to the common shareholders has a result in an $80,000 increase to retained earnings, everything else staying the same. So, and we'll use that in part C, as you can see on the screen. So to calculate the earnings per share, we simply take the earnings available to the common shareholders, which is the $110,000, and you divide it by the 20,000 common shares that are currently outstanding, and you wind up with $5.50 per share. So a nice, simple, straight calculation. Now, the dividends in this particular case are, they didn't pay out the whole $110,000, you only paid out $30,000. So the dividends of $30,000, and you have 20,000 common shares, means that each share was paid a dividend of $1.50. So the dividends per share is different than the earnings per share. So you kept $4 per share and you paid out $1.50. The payout ratio is simply the dividends per share divided by the earnings per share. So of the $5.50 you earned, you only paid out $1.50, which is just over 27%. As I mentioned earlier, there is an increase of $80,000 in retained earnings from what I described above. And your PE ratio based on a share price of $26.40 divided by the earnings per share, not the dividends per share, the earnings per share of $5.50 means that for every dollar of earnings, that there is $4.80 of price. So $5.50 worth of earnings will result in a share price of $26.40. If the share price were to increase, it would be because the earnings have increased. So let's say the earnings go up by 10 cents. That means you would multiply that by the 4.8 and your share price would go up by 48 cents. So you can simply multiply the two. So that's a nice straightforward example. Hopefully my explanation has been clear. And we'll move on to a new problem.